Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I like to play an economist on TV every once in a while. More importantly, I am joined, as always, by the one, the only trader extraordinaire, Wall Street legend, founder of Ascalon 6 Capital, Antoni Esposito. Anthony, how's life treating you, my friend?
A lot of dramatic pauses in there, my friend. I like it. Life's good, busy, but good. We're having a very exciting week this week. We actually had a shortened cash session week and actually shortened futures as well, because tomorrow is Friday. We will be no cash trading tomorrow in the U.S. We had triple witching today as far as options expirations. And we had Mr. Warsh's first Fed meeting yesterday, which I'd like to speak to you about. So really looking for your general feel for how he did and what the approach is going to be. In short, from my seat, and then I'm going to dish it because I really want to hear what you have to say. From my seat, market reacted very poorly. A lot of volatility, downside skew to the market after his announcement. It seemed hawkish. Less information will be forthcoming. He did not participate in the dot plots, which I loved. Wants the market to be a big boy, essentially, and make its call, not make a call based on what the Fed's call is. And the market was pretty bearish, came off pretty hard at the end of the day. Bounced back today into a triple witching expiration, which could have definitely skewed the move. But you heard the call, Washington first meeting. What do you think about it generally across the board, his approach and where we're heading?
I thought it was great. And frankly, Anthony, everything was exactly as we thought it was going to be, right? Warsh was not offering forward guidance. He was not offering his projections. And I don't understand these talking heads in the media who are saying, oh, no, markets are going to be like flying blind or some other nonsense. Give me a break. So you're no longer going to get the guesses of Fed participants. So what? The guesses literally change from meeting to meeting, and they don't actually affect the interest rate decisions because those are based on backward-looking data, not forward-looking projections. The projections have just proven wrong time and time again over the last several years. They're useless. That's part of, not the only reason, but that's part of the reason why Warsh is getting rid of it. And in terms of his tone, that was exactly as we expected. In terms of the interest rate decision, as expected, even the fact that they kept the inclusion of the ample reserve regime, that again, that was as expected, because we discussed previously, it is going to take him more than one meeting to get enough people on board to actually vote to change that and start rolling back the novel monetary framework that we have today that was really created after the GFC. So again, I was a bit surprised at the sell-off, just simply because literally everything was as expected. But maybe it was just as you and I and a few other participants were expecting, and not the not the broader market there. But I was thrilled with everything I heard.
Good. Yeah, I was too. I think the market sold off. Essentially, we've been seeing, and we say the headlines are interchangeable all the time. This was obviously
exactly
a data point, but we've been seeing a breakdown in momentum and trend for the past 2 weeks in the Russell and the S&P. Gold for sure. I won't even get into that, but the gold is definitely heavy and being pressed. That's been, we're 3 to 4 weeks into that for sure. But we're seeing a break in momentum trend in the equities futures that we're trading here at Ascalon. So it's been a bit of a scramble, a bit of a volatile move, but we do look like we are looking for excuses to sell off and excuses to rally, apparently. So we're definitely stuck in that churn, but we're stuck in a churn near all-time highs with higher volatility and degrading momentum and trend, which typically is the sign that we are going to break and there is going to be some retracement. We saw a big down day last Friday, down 3% intraday. That's a big move down intraday for the S&P. We had a couple of other dips during the week this week. So there's been some volatility. I think people just jumped onto the statements as hawkish or not as dovish or not as squeamish as Powell. He kept everything close. He answered what he wanted to answer. He did not answer what he didn't want to answer. And he essentially said, you're all big boys. We're going to make our decisions based on better data. And you're going to need to make a decision when you see what our decision is. We're not going to share all of our forward-looking, our ideas, our thoughts, and our most precious hopes and dreams with everyone. The market needs to earn its money. So I was happy with it as expected. Whip down after the announcement. whip up today into triple witching and expiration and a 3-day weekend. So we'll see what happens. One thing as this relates to, right, we're talking about interest rates and we're talking about inflation and affordability. It all kind of rolls up. And we had yesterday morning, which honestly, I said before, feels like it was a week ago, but it was yesterday morning. We had retail sales come in. So retail sales slightly better across the board. Advanced retail sales month over month 0.9 versus 0.6. And we had ex auto month over month 0.8 versus 0.6. We have that quick Bloomberg snip of the table. And what kind of sticks out to me is we keep talking about the consumer. And I know the consumer and the strength of the consumer, most people relate it directly to employment. If employment is healthy, they believe the consumer will continue to spend, borrow, spend, borrow, spend, borrow, spend, and that will be where we go. We do have another chart, which I thought was interesting and related to of the consumer. And you and I have talked about the consumer credit levels, which are astronomical. This is actually a chart out of Hedgeye, which is looking at the hardship withdrawals from Vanguard. And I wanted to get your take on this. If we go back to 2020, the percentage of participants requesting hardship withdrawals at 2%, you can see we steadily increased from 2020 to 2025 at 6%. I'm going to venture to guess that in 2020, that's 25 and 26. I'm going to venture to guess that 2026 is above 6%. What's your take on this? I mean, do you believe that the consumer is actually healthy? And do you believe that there is, and if not, do you believe there's a brick wall somewhere or a massive speed bump that we're not accounting for?
Great question, Anthony. The short answer is it depends on which consumer you're talking about. The K-shaped economy is very, very real, right? We've talked before a lot actually about how more than half of consumer spending today comes from just the top 10% of income earners.
Yep.
And so that's just the reality that you have to deal with. And when we look at the debt loads that consumers have been taking on over the last several years, it is not at all evenly distributed across that income spectrum, right? So I think that's a big part of the problem here is the abnormal distribution of these things, whether it's the income, whether it's the spending, whether it's the debt load. Now, all that being said, it is very, very clear that when we look at things like the hardship withdrawals out of 401ks, this is something I've highlighted in previous studies on retirement accounts in the United States that I've done, is the fact that you are seeing people able to save less in the aggregate. And the result of that is not only for that kind of marginal saver that they're choosing to not save anything instead of saving. So that's helping draw down 401k balances. But then you go to the other, I guess, extreme, where people who haven't been saving anything for a while now, they've had to stop saving for quite a long time. Now they are getting pushed even further to the point where they're having to withdraw. They're having to dis-save, as they sometimes call it. And one of the things I find really interesting here, Anthony, is that, again, as we dig through the data, we're increasingly finding, it's some Gen X, it's still some of the younger boomers who are digging into their retirement savings, not just to pay their own bills, but to pay their kids' bills, which I just find absolutely fascinating. The number of kids today who are living at home with folks who are in their late 50s, early 60s, right? Again, folks who are very close to retirement but not quite there yet.
Yeah.
And they're doing these hardship withdrawals not just for their own bills, but for their children's bills too. And these are kids who don't have any retirement savings at all, right? So they have no 401k to tap. So again, that I just, once again, I think speaks to how tapped out a lot of consumers are. Now, again, it's not all consumers. There are plenty that still have a lot of disposable income, and perhaps more importantly, if you look at the total amount of credit card balances today, and you compare that to total lines of credit on those cards, in other words, what percent of the total is actually getting used up by people carrying balance from month to month? The vast majority is still available. The vast majority of that credit is still available to be lent. In other words, a lot of people, not on the lower end of the income spectrum, but a lot of folks, especially on the higher end, have a lot more access to credit than is being utilized right now. And so that indicates to us there's a lot more potential borrowing that can happen before the consumer, in other words, the whole aggregate, is genuinely tapped out.
Yeah, interesting. Yeah, the stats are interesting and the spending is interesting. I just wonder at what point do the middle and lower end consumers just fall off? Like, and I'm not
Hmm.
saying that that's
Hmm.
going to happen, but and I guess it comes to a point where, credit there is not available. The credit lines are tapped, um, prices are higher, and
Hmm.
they're no longer buying, even though they're only half of the consumption. Right, the bottom 90%, as you said, is half of the consumption. If you lose 20% of half of the consumption, you have a recession. I don't know if those are the exact numbers, but it's not a big, I don't think it's a big shift down. And with what we've
Right.
seen as far as pricing and what we've seen as far as a little bit of a shock at the pump with the Iran war, um,
Yeah.
there's definitely a stat like this sticks out to me, but I understand what you're saying. And it makes sense that, in this economy and the way we are set up and the K-shaped economy, the top 10% are really responsible for 50% of the spending. And that trickles down to other jobs for the middle and the lower class, right? If they're spending that much, then there's positions open, whether it's services or what have you. There's jobs open because the spending is in line or continuing from the top 10%. So that makes perfect sense. I think this is definitely something to watch, along with the individual consumer and households. We're seeing a massive retail push into the stock market and trading. I know last show we had a young woman with a pink ski mask heading out to work, saying she was going to rob the S&P of its money, which I think is hysterical. But it's becoming very dangerous because the Kalshis of the world and the crypto traders of the world and the equities and futures traders are all kind of meshed together now. And I do feel like we have a market that's really overheated and it's overloaded with really with speculators and gamblers,
Yeah.
which is fine because as a momentum trend strategy here, and it's essentially a contrarian swing trade strategy, we are speculators. We're not here to invest. I want liquidity and I want P&L. I don't want to sit in positions for 10 years. I'm not a full cycle guy. However, we just have an overload of people involved. And I think we are definitely at the highest percentage of households that have stock market exposure currently. And we're way beyond even developed Western nations in Europe. We are the number one nation in the world as far as exposure to the stock market. I believe Canada's behind us. But talk about that. We talk about valuation all the time. We're a
Hmm.
technical fund here, but I do like to look at valuations. I saw a really great chart. We're going to pull that up from Isabelnet on X, and it's talking about their ratio for all-time highs as far as valuation. So what they're taking into account here on the top of the chart, the top panel, are the average percentiles for their index, which is taking into account trailing PE, forward PE, the CAPE, which I love, cyclically adjusted PE, which is at an all-time high, matching 99 right now, just as a point. And that is the inflation-adjusted PE over a 10-year period. It is, in my opinion, the most important valuation metric. Price to sales, Q ratio, market cap to GDP, ROE. So they create this index, and you can see where the peaks are, which are really important here. So 1929, 1965, then we had 2000, which didn't make the top three. Keep that in mind. And then right now,
Wow.
which is the all-time high as far as the valuation goes. Now, I'm not saying that this is, you see this and then, you get short because tomorrow on Monday is
Right.
going to be the crash. What I am saying, though, is when you come up with, when you have a real firm come up with a real model and build out a valuation chart and be able to show you where their model, right, wrong, or indifferent, right, their model shows in retrospect where the max valuations were for the market. And we are at an all-time high now on their model, and their max valuations in previous peaks coincided with market crashes. I think it's something that you want to pay attention to, right? So you're
Hmm.
overloaded with positives, you're overloaded with the bullish story, you're overloaded with the reason to buy and never look back, or throw a pink ski mask on and go to your house and steal money from the SPX. You know, look at some of the other things that are going on, and there's a ton of them. Microsoft was out this week saying that they're going to actually engage DeepSeek for some of their AI needs, and they were going away from OpenAI. This is a big deal. Remember, in December of 24, the night DeepSeek came out and said we're within 5% of your compute power, and we use 1/30th, literally 1/30th or 1/25th of your energy. The market in the overnight was down 3%, the futures. Then we recovered, took another dip, recovered, and then we entered into the tariff tantrum and took our dip. But I guess my point is the negative headlines are not really being talked about too much as far as the amount of capital being raised, the amount of debt being issued. Now they're issuing stock instead of debt, so they're diluting shareholder equity. You look at all those things that are building under the hood that could be negatives and could be kind of canaries in the coal mine. And then you see a reputable firm come out with their valuations saying we're at all-time highs. And then you look at the cyclically adjusted PE and say we are at 1999, 2000 bubble highs. It's something to pay attention to. So just wanted to point out valuations are extremely stretched and something to certainly pay attention to. I don't know if you've spoken to, I know you do deal with a good amount of investors and donors. What's the feel from you? Do people feel like we're overvalued? Do people feel like there's a reason to kind of look over their shoulder, or is it kind of ears pinned back and leveraged up and let's go?
A great question, Anthony. There's this weird kind of bifurcation right now in the folks that I talk to, where on the one hand, there are plenty of folks who seem to be falling into that mental trap, I guess, of thinking, what do you mean it's going to stop? Like, this will go on forever. I'm like, this is literally what people said in 2005, 6, and 7, like, and then obviously back in .com. But it's shocking how that mentality really has come back for some folks.
Yeah.
And then there are others that I talk to who are so incredibly worried and have actually basically just abandoned the equity market entirely and plowed everything they have into fixed income because they're just so worried. So I guess it's kind of weird how you seem to have one extreme or the other, at least in the in the circles that I've been walking in.
Okay, that makes sense. Look, human nature doesn't change, right? So everything repeats itself. Yeah. So you definitely get people that go right back to the loop of fear and greed, which drives the market both ways. It is what it is. I think that's why I like the technicals so much and why I love being a CMT. You get to actually see people's emotions and the fear and greed in a pretty picture on Bloomberg and make a decision. I don't think people will ever change. And I do think we have a lot of very young professionals in the business who are very talented and very smart, but they don't have the life experience of witnessing true bear markets and true collapse within the markets and the system. So with that said, I think the buy the dip mentality is really alive, whether it be retail, whether it be high net worth, whether it be financial advisors, or whether it be professionals on the buy side or the sell side on Wall Street. I think there's a lot to be learned. And I do feel that the lesson is going to be learned during this cycle because we are at massive extremes. So bifurcated for sure. You're sitting on the sideline, you're cautious, you're probably feeling a little FOMO right now, and maybe people giggling at you when you go out for dinner. But
when I'm trading, I do actually wear this ski mask because I need the market to know that I'm here to take his money. People ask me all the time, they be like, hey, why you got that ski mask on? Like, girl, ain't you high? No! I'm taking the market's money! Take that, SPX!
Now, what you don't know is we have one of our traders is actually heading to Durham University next month. He got a football scholarship, American football scholarship. He's getting his master's in finance. So we actually put out and started interviewing for the job. I'm happy to say that the person you just saw is actually taking the seat. So she will be trading with Ascalon 6 as of September 1st.
I'm pulling my money.
Really, really happy to welcome her. Jalen, my other trader, is very looking forward to showing her the ropes and training her here. And we hope for great things. We are definitely very optimistic. Very optimistic.
My goodness.
EJ, my friend, thank you, brother. It's been real. You're the best. I don't know how long it's going to take you to wear all those hats, but good luck.
Yeah, fortunately they're my buddies, not mine, so I don't got it. You know what? I don't even know if they would fit my dome, to be honest. But
What do you got going on there? 7 1/8, 7 1/4?
oh goodness, I don't know. It's too big. That's all I know. It's too big. Okay.
I'll buy you a bucket for Christmas. You can wear that as a hat. Paint your
A
favorite
Home
team.
Depot 5-gallon bucket. Do everyone a favor, hide my face.
Have a good night, man. Thank you. Talk to you soon.
You too, Anthony. Till next time.
Bye-bye.